I'm Adele Hutting, and today our focus of our discussion is how exchange-traded funds, or ETFs, are used for not only passive management, but for active management, hedging, and liquidity management purposes. I want to pose this question to Johan and then to Ben. How has the local ETF market evolved from your perspective? ETFs have clearly become so much more than just passive. So maybe, Johan, you can enlighten us.
Yeah, I think ETFs has been with us in the local market for a couple of years now, and we've gone from one player to multiple players in this market. We've gone from single products to a lot more complex products in this market as well. At this stage, I think everybody believes that given the industry, either from the consumer perspective being a push factor or a push factor from a regulatory perspective, as well as a pull factor from a simplification, cheaper costs, all of that, to grow in line with what we've seen in the international market. If you take a look, local South African market, only about 5% of your assets, or a very small part of it under management, is actually invested into ETFs at this stage, and the bulk of those are actually in commodity ETFs. However, you've seen a large proliferation of products moving from the commodity standalone products to the baskets or the indices, as one would refer, your well-known indices, local indices, top 40, Swiss 40, that's moved into some smart ETFs where you're having specific divvy trackers and that. And what you've seen coming of late is a proliferation of your offshore linked ETFs. So in that basis, what you can see is how this market starts building on each other, how there's more and more participants. And I believe that this is only going to gain more traction and more buy-in from investors. And the investors in these markets are retail investors, institutional investors, and depending on what the underlying uses are that the people are actually starting to look at these funds for.
Okay. So Ben, from your perspective, what have you seen?
Well, as Johan explained, because of all the products and all the asset classes that one can cover now, there's much broader acceptance of ETFs. You know, when this industry started in South Africa way back in 2000, you had to go and explain what the ETF is to your customers. You know, so first of all, there's a general acceptance of ETFs as products that one can use. And one thing that we're seeing of late is that the use of the ETFs is becoming more sophisticated, because ETFs are now being used as part of bigger solutions, and it's not the only solution. I think it took a couple of years for that mindset to take hold in South Africa. I think if you look at a couple of years back, you had issuers that issued ETF solutions, and sometimes they were sold as the solution within the products. But there's a broader acceptance now in the industry is how do you use these components as part of a bigger solution, which leads to the bigger sort of evolution of thought, if you like, from back in the day, ETFs was viewed as a passive investment. And there's definitely this whole debate around should it be active, should it be passive, frankly is nonsense. And there's no such thing as a passive investment decision. You know, where ETFs is now used by active managers, by various solution providers as well. And I think there's the acceptance that one can see the value of the ETFs.
So not only has the ETF product changed, but the multiple uses of this instrument has also changed. At one stage, ETFs accounted for roughly 30% of all US trading by value. Investors are clearly utilizing this instrument in very different ways. So I want to ask you, Maurice, what are some of the ways that ETFs can be utilized in portfolios? We all know that exchange-traded funds trade exactly like ordinary shares.
Yeah. So, I mean, we're having a discussion a little bit earlier about the US market. And it's pretty evident to see that US investors are now trading ETFs like any other share to get the exposure to the underlying market. And the spreads on the ETF are a lot tighter in the actual ETF trading than they are in the basket of shares that make up the index that ETF is trading. In South Africa, we've got a slightly different offering, and that as as Johan had mentioned, that people are using ETFs to get exposure to commodities, where commodities were previously inaccessible due to a number of issues, one of them being myself as a retail investor. I can't hold gold in any form or shape, but I can hold a new gold or a Standard Bank or ABSA sort of gold ETF. So you're finding that from a South African perspective, our use of ETFs, we're just starting to develop and we're trying to meet sort of our needs. You have a proliferation of foreign ETFs which people are using to externalize sort of their investment while still not reaching their prudential limits. So depending on whether you're looking at a retail investor or you're looking at an institutional investor, there are different uses of ETFs. But bottom line is that it's a cost-effective way to get exposure to a number of multi-asset classes or even single asset classes. That's what people are using it for at the moment. Cost-wise, some people do use it to drive down some of their cost. And ETFs in SA are relatively cheap, but relatively expensive to foreign ETFs. I think our cheapest ETF is around 5 basis points, and our most expensive ETF is sitting at close to 85 basis points. So just depending on what the investor is actually looking out for, ETF does cater to those differing needs. But ultimately what investors want is to generate returns within the ambit of the mandates that they're given.
Thanks, Maurice. I think I'm going to ask for a different perspective as well, and I'm going to ask Len if you can maybe add your thoughts.
So what we've seen, an ETF is essentially a hybrid of a share and a unit trust. So it essentially appeals to a very broad audience of investors or of financial market professionals. So the first and most basic strategy that we're seeing is a core satellite approach. So if you're an investor in equities, it makes sense to try and reduce the cost of your holding. That's probably the biggest benefit that ETFs offer is a reduction of costs. So to hold 60 or 70% in an index tracker of some form makes a lot of sense and adds to your return over time. But then you don't necessarily want to just get the market's return. So you can allocate then money to active managers. And I think what we've seen in South Africa that's encouraging is that you're getting a lot more active managers that are taking big bets away from the benchmark. South Africa, typically when you benchmark an asset manager, you're tying one hand behind his back and you're not allowing him to outperform. Whereas we've seen with the statistics now coming out of ASISA is that we've got some very high alpha, very active asset managers that are actually gathering assets now. And that's probably not logically, it's actually very good for passive managers as well, because no one's going to give all of their money to the high alpha guys. They're going to split their portfolio between index trackers and high alpha. So that's the first strategy we're seeing. The second strategy is where people construct portfolios, multi-asset portfolios, who aren't necessarily very good at picking underlying managers. They don't want their asset allocation decision to be diluted by picking a bad manager. So they're executing those strategies by buying index tracking funds. And then the third strategy that we're starting to see now is where people are actually using ETFs as replacements for derivatives. They're starting to use ETFs to short the market, because that actually raises cash in your portfolio. So we're seeing some hedge fund managers, rather than using a derivative to short the market, they're actually shorting the ETF, and that's obviously a sale. So they realize all that cash in their portfolio, and they use that in other areas, in other strategies and to execute elsewhere. So our market is getting quite sophisticated in terms of how they use ETFs, and that's encouraging. And people are using them for asset management, for long-term investments, but they're also using them on a more speculative basis, which I think is an advantage that ETFs have over unit trusts.
Well, so it's quite evident that things have really changed since late 2000 when the first ETF listed. And we're actually in a very different sphere at the moment.
South Africa's financial markets are very advanced on a global scale, on a global basis. So we learn very fast from what happens overseas. And it's encouraging to see that has translated into the ETF market. Our products are world class. So if you look at our products compared to the rest of the market, there are certain things that we can't do, leveraged ETFs, those kind of things. But the trading strategies have caught up very fast over the last 3 years.
Okay. Thank you. That's very insightful. Thank you, Len. if we talk about accessibility, Maurice, I'm going to ask you to jump in here. How easy is it for investors to access ETFs on the exchange, particularly when wanting to transact in large sizes, and perhaps even wanting to access traditionally very difficult to access assets with African equities, excluding South Africa when I talk about African? From your perspective, what have you seen in terms of accessibility?
So we're on a number of platforms, but you'd find your institutional investors still like to use their traditional pick up the phone and place an order type of brokers. But because ETFs are traded like shares, you can buy them on any online platform. So what it comes down to is how much liquidity is available in the underlying in the ETF, in the underlying market, and then also in the secondary market where people trade. Because the one sort of handicap of ETFs is that they have to trade what's available in the secondary market on a daily basis. So if your holders of the ETF don't want to sell, you're going to have very little liquidity that people can pick up and literally buy. And the other alternative is that they have to pick up the phone and call you or send you an email and ask you to then create these ETF units. So I think that's one of the things that we challenged with, is that the secondary market liquidity is not as deep as it would be for the underlying shares that are traded in the ETF. But for anybody else, I mean, ETFs should be and is as easy to buy as pulling out your phone, downloading an app, putting in your details and saying, this is how much I'd like to invest. Personally, I use Standard Bank online share trading, so I sort of hold my ETFs in that portfolio. But there are new players like Easy Equities is also a strong player where you can download the app in 5 minutes, your account's open. You decide what you want to buy on debit order or lump sum and it's done. For institutional investors, as they sort of take up ETFs into the market, they're still having to contact the market maker or the ETF issuer directly. And so it creates that 1 day or 2 day time delay that the retail investor doesn't have to face because of the sheer size that they're looking for.
And then these institutional investors, I would imagine for a large transaction, they could transact at net asset value, at NAV.
Yeah, so they can transact at NAV. They can also, they typically would definitely want to transact at NAV. What you then have is you have to look at the underlying market. So with us, we have to manage some of the risk in the rest of Africa because an investor may want to trade on a particular day. We have to get the units done, so you've got a bit of currency risk for 1 or 2 days. Then you've got some liquidity risk in the underlying markets, in that the markets may be closed due to a public holiday in a variety of markets that you trade in. So there is also a timing difference. Some markets may be open, some markets may be closed when you're giving an investor that price. So while you do want to issue them at NAV, you do have to account for some of these additional risks by increasing the spread somewhat to the NAV as investors then come into the product.
Okay, yeah. Great. Thanks, Maurice. It's good to know that there are different channels available to whichever investor is wanting to trade or invest in ETFs.
But it's also a function of cost. So you have different channels, but even the retail investor is often the misconception that you have to access the ETF on the platform because that's the most cost-efficient way to access it. That's not necessarily the case. It depends on the size of your investment. You've mentioned online share trading platforms. So I think what's important for the retail investor is to do that cost analysis of what's the most efficient platform to buy. And you find in size, going through a stockbroker tend to be your most cost-efficient way to do it. And as you rightfully said, institutional investors, for that reason, go through stockbrokers because that's the most efficient way to actually access the ETFs. And the big advantage of ETFs from an accessibility perspective is that your retail investor have the same access as your institutional investor because the market makers on screen all the time in terms of JSE listings requirements. So you have liquidity there. There can be liquidity constraints, as you rightfully pointed out, for the big institutional investor, because that's a function of the underlying market security, but market listed securities of the underlying. But that is really what market makers do. They would facilitate the security for institutional investor and ensure that you get the most efficient trading.
Thank you.
Yeah, for me, what both Maurice and Ben said is there's additional aspects to that one has to look at as well. And one of the additional costs that comes on that Maurice has mentioned is also funding. because of the settlement cycles and that, the market maker or the seller has to hold his hedge. So yes, he has to acquire it, he has to holding costs and all of that. So by the mere expectation that things trade on NAV, that is the NAV, and in theory it is, but it excludes all other holding costs, funding costs, hedging costs, all of that. And as the market gets more sophisticated, those come down.
And scale builds.
Scale build, but they are still there. And those are even more applicable when there's primary market creations versus secondary market creations. And I'm sure one of my colleagues, Len, can chat about that a bit later. But insofar as one of the other additional points that needs to be remembered in this is also in terms of your access. There's all the platforms have got debit. Most of the banks have got debit order platforms now for their internet banking account holders, which become very cheap to hold as well. And one has to look. It's a combination of your fund costs, your ETF costs, and I know everybody debates, yes, when are we getting to zero? Well, one has to look at the complexity of the underlying asset that you are tracking. The more vanilla it is, the lower the cost, and the more complex it is, the higher the cost it is. So not all ETFs are going to trade at 5 basis points. It's just not going to happen because of the complexity. And then one also has to look at the underlying platform costs. And I know it's quite a buzzword internationally right now that there's free ETFs and that.
Correct.
But a lot of people are then missing the additional marketing around it, where there's platform costs and advice costs and all of that. That forms part of that package of free ETFs. So people really need to look at the full picture before they just say, this is what it is and this is what I demand. So is my one big advice around this.
So I'm going to pose the next question to Maurice and Len. What do you believe is an invaluable benefit of ETFs that many might not know of? What do you think is the best kept secret around ETFs?
So I don't think it's a secret. ETFs provide you with the return of the market, and that's kind of been what we've hung our hat on for the last 20 years since ETFs have been around. What we often hear from investors is that they're of the opinion that South Africa is somehow an exception to the rest of the world, and that active managers can in fact outperform the benchmark index of the JSE. Most of the research that we've seen, and certainly the SPIVA awards or report that S&P issues, would contradict that. South Africa has very much the same ratio of active managers that can outperform the market, and it's a very small percentage, less than 25% of active managers outperform the market consistently. The second big advantage, I think, of ETFs is that if you are taking exposure to the equities market, generally you would go and buy shares, and a share transaction includes 0.25% transaction tax. It's probably the biggest direct cost in a portfolio. But if you buy ETFs are in fact exempt from that tax. And you by buying an ETF, you're actually getting a 0.25% excess return on day one.
Yeah.
Absolutely. And then the third thing is we see a lot of debate about whether you should be buying a unit trust or an ETF, and the fact that unit trusts trade at NAV, but ETFs, there's a spread around the price. And my argument to that, and I'm not saying that ETFs are better than unit trusts, it just depends on what kind of an investor you are, is that with an ETF you have absolute certainty of where the market is at the time that you purchase. Unit trusts, you end up paying, you end up buying your units at the day before's price, and you don't know, maybe the market has declined in that 24 hours and you would have got a better price if you traded today. So you do pay a slightly more when you purchase the ETF, but you're paying for the certainty of the price that you're getting. It reflects the market at the time that you do the purchase.
Well, added on to that, I mean,
please.
your other benefit between an ETF and a unit trust is that from an issuer's perspective, it's more cost efficient to run an ETF. So you actually find, if you go and look at like for like ETF trackers and unit trust trackers, your ETF trackers tend to be more cost efficient, cheaper basically, than your unit trust trackers as well. So there's a direct benefit from a cost perspective as well, because it's more efficient for the issuer to run an ETF. And a big difference why it's more cost efficient, because your whole client liability management sits within Straight. So you
It's
don't.
automated, yeah.
It's effectively automated. You leverage off a very efficient share settlements as we get all the benefits of normal share trading. So if the whole client liability management sits in straight, that's what the issuer don't have to do. So there's less responsibility and onus on the manco of the ETF to do that. So they tend to be more cost efficient than a unit trust.
There's a second reason for it, and that is that with a unit trust, for every rand that comes into the portfolio, the manager has to go and buy a share. Whereas most of the trading in ETFs actually happens between third parties. So
Absolutely.
if an investor's coming in and investors going out on the same day, they will trade with each other, and the fund itself won't have to incur any costs. But with a unit trust, if you've got two people, one's buying and one's selling, I've got to sell to the portfolio, and the portfolio's got to go and buy from
So
Exactly.
someone else.
operationally efficient, yeah.
Yeah, so you're almost
Operational
doubling up on trading costs in a unit trust versus
Yes.
an ETF.
Okay, thank you.
I think a lot of that's got to do as well as the ETF, because the ETF is real time. It is, for each investor, it holds the underlying constitutes directly at that stage. So you can never have a situation where when the first investor in a portfolio or out of a portfolio can benefit from changes in that portfolio in terms of the next day. And a good example is where you would have one of the underlying constitutes, a share in a portfolio, that unexpectedly in the day actually loses a lot of value. If you were buying the unit trust today, you would have bought that at yesterday's
Right,
price
yeah. So it's a
with
delay.
that share included, and your more astute investor would have sold your unit trust today immediately and then benefited, i.e. the price benefit or the price loss in this instance would be borne by the new investor coming into this fund at yesterday's price and not by the investor exiting at yesterday's price. So that's one of the real efficiencies and real-time pricing benefits that you get into ETFs that unit trusts
Don't
don't
offer.
have. Yeah.
Great.
And why a lot more astute investors move to ETF and ETF trading versus unit trust trading.
Okay, thank you.
I mean, for me, I think one association people sometimes fail to make is that, and a lot of institutional investors speak about this term, which is called impact investing, or making an investment that has a social impact. So when you look at the ETF market, in essence, it democratizes people being able to save and invest in the stock market and being able to get the investment returns that the stock market offers. Whereas historically, that's been left off to rather wealthy people or the few high net worth individuals in the country. So when you take a country like South Africa, I mean, why institutional support for ETFs is very important is that the ripple effect on society is quite high. Individuals can invest tax-free to a large extent into ETFs. And we're talking like 2.5 or 2,700 Rand a month that they can put behind this. And so your institution can be found to be investing alongside some of its members from time to time, and then having a social impact in that savings and investment starts to increase in the country, which is something we desperately need.
Okay, so in closing, if I can ask each of you gentlemen to please just share your final thoughts on what you think should be shared.
Yeah, thanks, Adele. For me, one of the most important things that everybody needs to remember is ETFs is not just an investment product. ETFs is a housing or a wrapper, and underlying that is the different investment products, investment strategies, trading strategies, all of that. So one has to look, and for me, users, and I don't even call it investors, as users of ETF, need to look at it in a very different light on that basis, that they can actually use these ETF wrappers in so many different forms to achieve their ultimate goals. And if there's one takeaway point for me that people need to remember and think about, that would be the one.
Okay, right. Maurice.
For me, it's fairly simple. ETFs are not all passive. I think of, when you hear some of the stories, there's a lot of work that actually goes into running an ETF and a lot of work that goes into managing the risk of an ETF. I mean, if you simply think of the commodity ETFs, what it would take to physically store gold, or move gold around the world, etc. That's a lot of work. And even in us, in some of the markets we operate in African markets, and so there's a lot of risk, country risk, that you have to assess actively on a daily basis. So I think the misconception that ETF managers are just passive investors running paper portfolios is quite, has to be challenged a little bit.
Okay, great. Ben, I'm going to leave you to the next answer.
So for me, being the misconception, or ETFs often compared to unit trust. And one thing is, I think it's extremely important, it's exchange traded fund. And the trading aspect is not well enough understood in the market and is not utilized as it should in the South African market compared to overseas market. Leonard touched on it earlier. There is more users of it, but we haven't seen the liquidity in ETFs that one would expect. So there's a lot of work that needs to happen, understanding in the market on the tradability, and that's your fundamental difference between your ETFs, other funds, unit trusts, and so forth, is the tradability. And how do you leverage that tradability to the benefit of your portfolio? Being your active manager, passive manager, solution provider, the tradability aspect of it needs to be amplified.
Thank you. And then lastly, from your side.
So I think the misconceptions that I've seen in the market relate predominantly to cost. And, even though ETFs are much cheaper than active funds, a lot of people are still quite critical of the costs, because they look overseas and they say, I can buy a fund offshore now for 0 basis points, and your 25 is quite expensive. I think the fact of the matter is our market has got a relatively conservative regulatory environment, and our ETFs are far safer than the offshore ones. There's some credit risk in offshore ETFs that we don't have here. We're limited in terms of how much script lending we can do in portfolios, and the chance of you losing money due to some sort of event like fraud or something like that is much lower in South Africa than it would be offshore. So you pay for that safety. It's not necessarily the cost of us paying the regulator, but there's a regulatory charge associated with complying with the regulations. And then the second thing is, predominantly with institutional investors, is you're going to see them and try and sell them an ETF for 25 basis points, and they'll laugh you out of the room, because they'll have seen an active manager before who quotes them 10 or 15 basis points. Now, the fact of the matter is, when you're comparing costs, is that an active manager only quotes you an asset management fee, whereas because we're a regulated fund as an ETF, we have to add up all of the costs in the portfolio, including the custody and the auditing and all that kind of thing, put it all together, and that's why our fees look so much more expensive. If we had to just strip out the asset management fee, ETFs would compare very favorably to segregated mandates.
That's all in cost.
Yeah, so I think there's an educational drive that the ETF industry has to do, is to inform pension funds in particular that the fee that we quote them is an all-in fee, whereas what asset managers quote them is usually just the asset management fee, and those things aren't comparable.
Right, thank you, Lee. And thank you to all of you today. I really do appreciate your time.